This is your 10th program in the series on the principles of accounting. A simple cash flow accounting system is useful for an individual's personal records or for a small personal service enterprise. But organizations which get revenue from sales of goods held for a while in inventory need a method to accrue the effects of such sales and the effects of the purchase and handling of such goods, since they're usually sold and purchased by credit rather than cash. A firm which on March 1st had $10,000 worth of inventory on hand and received $6,000 worth from its suppliers, returning $1,000 worth for various reasons, had a total of $15,000 of inventory it could sell. If it sold $12,000 of such merchandise, which originally cost $8,000 before handling, service, and sales expenses, received $10,000 in cash for previous and current sales, paid $7,000 for previous and current purchases, and spent $2,000 for certain expenses during the month, what did it need? Right. When purchase and sale of goods make up a substantial part of a firm's operations, and especially when credit is involved, one just can't look into the till or the bank balance and tell whether a profit or loss was made, and how much. Profit or loss is the remainder after all costs, consisting of expenses and purchase costs, have been subtracted from the amount of total sales. In a simple merchandising operation which does not manufacture, modify, or add directly very much value to the goods purchased and sold except by storage and selling efforts, the direct cost of the goods which are sold is simply determined for a month by adding the purchases during the month to the net decrease in inventory. If there's an increase in inventory, the cost of goods sold is purchases minus inventory increase. Another way of saying this is to say that cost of goods sold equals purchases plus beginning inventory less ending inventory. If there were no change in inventory, the cost of goods sold would equal what? Yes. Of course, if you wish to look at matters in a sort of time sequence, you could also say that cost of goods sold equals beginning inventory plus purchases less ending inventory. Beginning or ending inventory means, of course, the total value of merchandise inventory at the beginning or end of the month or other accounting period. Also, purchases in the cost of goods sold equation means net purchases, that is, total purchases minus goods which are returned to suppliers for some reason, whether they were received during the period or earlier. You'll find later that net sales has a similar return for credit feature. How could you describe cost of goods sold? Yes. Remember, profit is what remains after expenses and cost of goods are subtracted from sales. If only cost of goods sold is subtracted from sales, you get an intermediate amount called gross margin, from which you then must also subtract expenses to get profit. Sometimes the difference between sales and cost of goods is called gross profit instead of gross margin, but since this is often misleading, always use gross margin. Don't forget, gross margin is the difference between sales and cost of goods sold. In turn, cost of goods sold is made up of purchases plus beginning inventory minus ending inventory. Also remember, both sales and purchases are net, or less any returns for credit. Let's say sales were $52,000 less $2,000 returned from customers, or $50,000 net. If the purchases were $31,000 less $1,000 returned to suppliers, net purchases were $30,000. If beginning inventory was $26,000 and ending inventory $24,000, inventory decreased by $2,000, and cost of goods sold was $32,000. What was the gross margin? Yes. Obviously, you must keep accounts for purchases, sales, and inventory. For management review, separate accounts for purchase returns and sales returns are often used. Like revenues, sales and purchases are temporary equity accounts, and since owner's equity is considered temporarily decreased by the cost of purchases, the purchase account will be debited to record the cost of the goods purchased. The offsetting credit entry for a purchase will normally be in accounts payable, but sometimes you might credit what other account instead. The purchases account may also contain entries for freight or postage which directly apply to the goods received. A purchases, returns, and allowances account is set up to record credit entries for goods which are returned to suppliers for some valid reason. The offsetting debit for purchase returns is usually to accounts payable. If a purchase were returned to a supplier for an immediate refund, which is unlikely, what is the offsetting debit? Right. Purchases are often made by numbered purchase order, and when the goods arrive, they may be accompanied by a delivery slip, but the purchase transaction is completed when goods are delivered and a purchase invoice is received. The invoice is numbered and dated, usually refers to the purchase order number and date, lists the goods and their prices, and the total amount of the purchase. A lot of money is paid out for purchases, so someone must check each invoice for the proper amounts, prices, extensions, and totals. A bookkeeper may check the arithmetic and usually the correspondence between the invoiced items, their prices, and the original purchase order, but some merchandise specialist must check to be sure the proper goods and quantities have been received. And a third person may eventually be involved. Who is this? The initials or signatures of these persons should be on the invoice in a rubber-stamped form or an attached slip for the record. The invoice received for a purchase may also be assigned a special working number by the accounting department. This may be especially useful when the invoice is for more than one purchase order or for part of a purchase order. Most purchases of merchandise are made on a credit account. When purchased goods and the related invoice arrive and are checked off, what entries are made? Right. Accounts payable is a liability account, of course, and the managers need to know what amounts are owed, to whom, and their total. Money owed and later paid to suppliers is documented by an unpaid invoice file and an invoice record, which may be chronological or classified into individual accounts for major suppliers and a sub-account for miscellaneous suppliers, all in the ledger. A merchandising business may use a special original entry record called a purchases journal instead of entering purchases in a 2-column general journal or a combined journal. Each entry must record the date that the invoice is received, its number, the supplier, and the amount. What other information might be listed? Yes. Like other journals, entries from the purchases journal are later posted to the proper accounts in the ledger. This may be done only once a month by a summary posting procedure in which the total of purchases are debited to the purchases account and credited to accounts payable. If separate accounts are maintained for important suppliers, individual transactions may be posted directly from the invoices or from the journal. What is a term used for a single monthly posting from a purchases journal? Purchase invoices from suppliers which don't have separate ledger accounts should be filed at once in an unpaid invoice file in accordance with due date. If a discount is offered and will be taken, the effective due date is the discount date rather than the net payment due date. Invoices from a supplier should be paid in order and each paid in full. If payments are made out of order or in part, special notation and arrangements should be made. These are potential causes of error, so be careful. After payment, invoices in the miscellaneous file may be arranged alphabetically. Like the purchases account, the sales account is a temporary equity account for sales revenue. Sales are credited to this account since, as you recall, increases in equity are made by credit entries. What do you think would be the offsetting debit entry for a credit entry to sales revenue? Right. Some of the sales will be, in effect, canceled by the return of goods from customers. Such transactions, if they were quite rare, could be debited directly back to the sales revenue account, but a merchandise firm with a large number of sales will wish to account separately for sales returns and allowances. Separate reporting of sales and returns will help analysis of sales operations. The sales returns account is debited to record the returned goods. For every sale, some sort of permanent initial record is made. In a supermarket, it would be the cash register tape. For most other sales of goods, it would be a handwritten sales slip or ticket, usually in duplicate or triplicate. The customer gets a copy, and the accounting department gets the original, which is usually signed by the customer if it is a charge sale. The sales slip or ticket is imprinted with the firm's name and address, a serial number, and spaces for the customer's name and address, date, cash or charge, department, person receiving goods, a description of them, their price, and total amount of sale. If the goods are returned, the sales slip copy must be presented. What account would be posted for goods brought back by customers? Yes. Most retail sales are subject to a city or state sales tax proportional to their amount in even percentages, such as 2%, 3%, 5%, and so on. The salesman does not charge fractions of a cent, so a table is provided showing the number of cents charged for various fractions of a dollar. This table for charging 4% retail sales tax for amounts less than $1 should be posted and probably memorized. What tax should be charged at 4% on a sale of $3.25? Yes. Reports of sales taxes collected, due, and remitted are required, usually each month. Until it is paid to the state or city, it is a liability, entered by credits into the account sales tax payable. What entries are made as a result of paying the tax to the city or state? Right. Sales taxes are often considered a nuisance by merchants, but they're an effective and, in some respects, efficient means of collecting taxes. But bookkeepers for such firms must remember to adjust for returns and allowances, for sales to other firms for resale, or to tax-exempt customers like schools or to out-of-state customers which are exempt from sales tax. In some states, a small allowance is made to the merchant for the bother of sales tax collection. When posting sales subject to sales tax, you would normally debit cash or accounts receivable for the total and credit sales and sales tax payable for the separate amounts. A sale for $104, including tax, might be debited entirely to accounts receivable or cash and credited $100 to sales and $4 to sales tax payable. Some states allow merchants to credit the entire amount, including the tax, to the sales account, then once a month enter a calculated amount into sales tax payable. This might, for example, be 4/104ths of the total of sales plus taxes imposed. What is the usual posting of a sale? Yes. All cash cash sales slips must be carefully filed during a business period. The charged sales slips, which amount to invoices to the customer requiring payment, are retained in a set of files of unpaid accounts. Cash flow management is often critical to a business, so a currently posted summary, the ledger account Accounts Receivable, is used. This account should be continually debited for sales and credited for payments received from customers. At any time, the net debit balance is the total amount receivable from customers. Sales, like purchases, may have their special journal, the sales journal, for credit sales. Each month, the total sales are debited to accounts receivable and credited to sales. Sales journals usually have two credit columns, one for actual sales and one for sales tax. What are typical journals for a merchant? Right. The Purchases Journal lists credit purchases chronologically with dates, an internally assigned invoice number, supplier, and amounts. At the end of the period, the purchases account in the ledger is debited and accounts payable credited. Where are cash purchases first entered in the books? Yes. The sales journal lists credit sales chronologically, with dates and internally assigned sales slip or ticket numbers, customers, and amounts of sales and sales tax. At the end of the period, the accounts receivable account in the ledger is debited, and the sales tax payable accounts are credited. A trial balance is taken by footing all the general ledger accounts and adding debits and credits as usual. A schedule of accounts receivable and a schedule of accounts payable can be made up from the respective ledger accounts, showing only the unpaid balances and the customer and supplier names. After posting, checking by trial balance, and preparing monthly reports such as total sales and schedules of accounts receivable and payable, to find profit or loss, you must obtain the total direct cost of the goods sold and the related indirect costs, expenses for the month. The cost of goods sold is, of course, the net cost of purchases, including freight, during the month, plus or minus the decrease or increase of merchandise inventory. The expenses are made up of things like salaries, rent, and utilities. At the end of an accounting period, the asset account merchandise inventory, which shows merchandise which should be on hand, is debited to increase its balance or credited to decrease it. The offsetting entry is in a temporary equity summary account used for showing the profit or loss during the period. This summary account will collect the entries from purchases and sales revenues. How could you show cost of goods sold?